If you gave me £50,000 today and took everything else away, my property portfolio, my contacts, my reputation, my experience, everything, what would I do? Would I buy a buy-to-let? Would I buy a HMO? Would I start flipping houses? The answer might surprise you, because after more than 15 years investing in property, making mistakes, getting things wrong, and learning what actually works, I wouldn't necessarily do what I did when I first started. In fact, there are several things I do completely differently, and that's why I want to share with you today what I got wrong when I started. When I first started investing, I thought property investing was all about buying properties and collecting rent. I looked at yield, I looked at cash flow, I looked at whether a property made £100 or £200 a month. The problem is that if your goal is to build a sizable portfolio, that can be a very slow route. Now, don't get me wrong, cash flow matters, long-term wealth matters. But looking back, the properties that transformed my portfolio weren't the ones with the highest yields. They were the ones that I could create value. In fact, one of the biggest mistakes I made was thinking that I had to own everything myself. I thought 100% of one property was better than owning 50% of two. Looking back, I'm not sure that's right. The first question I would ask. Before buying anything, I'd ask myself one question. What is my goal? Because there are two completely different paths I could take. The first is building a long-term property portfolio whilst working full-time. The second is scaling as quickly as possible. Neither is right or wrong, but they require different strategies. Option 1, building a portfolio. If I was working full-time and wanted to build a long-term portfolio, I'd probably focus on 1-bedroom flats that can become 2-bedroom flats, or 2-bedroom houses that can become 3-bedroom houses. Why? Because they're relatively straightforward projects, they're easier to manage, they're lower risk, and they can often be completed alongside a full-time job. The objective here would be to buy, add value, refinance, and hold. Over time, I'd build a property portfolio of income-producing assets whilst recycling as much capital as possible. For most people, balancing a career, family, and property investing, this is probably the route I recommend. Option 2, scaling as fast as possible. Now, if my goal was to build capital as quickly as possible, I'd take a different approach. I'd still look for 1-bedroom flats that could become 2-bedroom flats. I'd still look for 2-bedroom houses that can become 3-bedroom houses. But instead of refinancing and holding onto them, I'd likely sell them. Why? Because every time you keep a property, some of your money remains trapped in the deal. When you sell, you get all of your money back. But more importantly, you get the profit and the equity that you've created. That allows you to roll everything into the next opportunity. Imagine starting with £50,000. Your first project turns that into £75,000. Your second project turns that into £120,000. Your third project turns that into £200,000. Now opportunities start opening up that simply weren't available when you first started. Maybe now you're looking at a house conversion. Maybe you're looking at a house into flats project. Maybe you're looking at a mixed-use building. The objective becomes snowballing capital into progressively larger projects. The question I ask on every viewing. One thing that's changed massively over the years is the question I ask when I walk into a property. When I first started, I'd look at the property and ask, would I live here? Do I like it? How much rent will it make? Today, I ask completely different questions. What could this become? Could this 1-bedroom become a 2-bedroom? Could this 2-bedroom become a 3-bedroom? Could this house become flats? Could I move the kitchen? Could I improve the layout? Most beginners focus on the property that exists today. The investors who create the most value focus on what the property could become tomorrow. My London Bridge lesson. One of the biggest lessons I learned came from a flat I owned near London Bridge. I purchased the property for around £330,000. By reconfiguring the layout and creating a second bedroom, the property was later valued at £450,000. The rent was great, but the thing that changed my portfolio wasn't the rent. It was the value that had been created. And most beginners ask, how much rent does it make? Today I ask, how much value can I create? That single shift in thinking changed everything. Why I like flats. One reason I particularly like flats is because they're relatively easy to sell. Think about who your buyers are. A first-time buyer could buy it, a homeowner could buy it, an investor could buy it. That gives you multiple exit routes. And if I decided I want to sell it, I've got a plan B. I can refinance it and keep it. Having multiple exits reduces risk. The second thing I would do differently. The second thing I do differently is that I wouldn't assume I had to fund everything myself. When I first started investing, I used to use all of my own money. I genuinely thought I had to own everything myself. Most of my early buy-to-let properties were funded entirely by me. Looking back, that probably slowed me down. What I've realized over the years is that if you can clearly explain what you're trying to achieve and demonstrate that opportunity makes sense, then there are often people who are willing to work with you. For example, if you had a partner who contributes half the money, you've effectively doubled your investment pot overnight. Instead of having access to £50,000, you now have access to £100,000. That opens up a completely different level of opportunity. What people get wrong about other people's money. Now, I hear a lot of people online talking about using other people's money. Personally, I think that message can be misleading because what some people really mean is use all of somebody else's money. And I don't agree with that approach. Whenever I've raised money for projects, investors nearly always ask me the same question. Rav, how much money are you putting into this project? Imagine if my answer was none. I certainly wouldn't invest in somebody else's project if they weren't investing alongside me. That's why whenever I've worked with investors, I've always invested my own money into the project as well. I want our interests to be aligned. We both win together. We both take risk together. So if I genuinely had to start again tomorrow, I'd absolutely be looking for partners. I'd absolutely be looking for investors. But I'd also be investing my own money alongside theirs. The investment pack. In fact, this is a real investment pack I used when raising money for one of my projects in Stevenage. But the reason I'm showing you this isn't because I think everyone watching should immediately go out and raise investor finance. The point I'm trying to make is that when I first started investing, I thought I had to fund everything myself. What I learned is that people are often willing to back opportunities if they can understand them. Notice what this pack does. It shows what we're buying, it shows what we're planning to create, it shows the costs, it shows the risks, and it shows how investors get their money back. In other words, it helps somebody understand the opportunity. Think about Dragon's Den. Many of the businesses that receive investment don't have years of trading history. Sometimes they don't even have a finished product. What they do have is a clear vision, a clear plan, and a founder who can explain why the opportunity makes sense. Property isn't that different. If you can show someone what you're buying, what you're spending on it, what the value you're creating, and where the risks are, people are far more likely to support you than you simply asking them for money. Why my thinking has changed. When I started investing, I bought a lot of standard buy-to-let properties, 3-bedroom terraced houses, buy them, rent them out, hold them for the long term. And to be fair, they've done well for me. But if I was starting again today, I'm not sure I'd build my portfolio in exactly the same way. The environment for landlords has changed. The Renters' Right Bill is increasing obligations on landlords. There continues to be discussion around EPC requirements and improving the energy efficiency of older housing stock. Compliance requirements seem to be increasing every year. Now, none of this means buy-to-let investing is dead, far from it, but the game is different from when I first started. In fact, today, as some of my older buy-to-let properties become vacant, I have no issue in selling them. Not because they've been bad investments, they've actually performed really well. The reason is simple. I believe capital can sometimes work harder elsewhere. If I can release £150,000 or £200,000 of equity from older properties and deploy that capital into a project where I can create significantly more value, that's something I'm willing to do. The biggest lesson. So if I lost everything tomorrow, I genuinely wouldn't panic because the most valuable thing I've built isn't my portfolio. It's the ability to analyze deals, spot opportunities, create value, raise money, negotiate, and solve problems. Nobody can take those skills away from me. And that's probably the biggest lesson I've learned over the last 15 years. Most people think they need more money. In reality, most people need better skills. So if you gave me £50,000 and forced me to start again tomorrow, I wouldn't be asking how many properties can I buy? I'd be asking how can I turn £50,000 into £100,000, then £100,000 into £250,000, then £250,000 into £500,000. Because capital creates options. And the more options you have, the bigger the opportunities become. If you've got any questions, leave them in the comments below. Thanks for watching, and I'll see you on the next video.